Welcome to the Deep Dive. Today, we're going to be diving headfirst into the fascinating world of corporate law.
Oh, fun!
We'll be using excerpts from a Tilburg University course on global law and corporate law as our guide. And you might be surprised at just how much variation there is in this field around the globe.
I bet.
It's more diverse than you'd think. To help us untangle all these complexities, we've got an expert joining us today.
It's great to be here. Yeah, corporate law can sometimes feel like a dense forest.
I bet.
But we're going to uncover that hidden logic behind all the rules and hopefully have some fun along the way.
I love that hidden logic. I'm already intrigued. So let's start with the basics. What exactly is a corporation, and why does it need all this legal machinery?
You know, it's funny. We talk about corporations every day, but we rarely stop to think about what they actually are.
Right.
The source material actually defines it in a way that highlights a very crucial concept.
Okay.
That's legal personality.
Yeah.
Which basically means that a corporation is treated as a separate entity from its owners in the eyes of the law.
Okay. That sounds kind of abstract, though. Can you give me an example? What does that mean in the real world?
Absolutely. Imagine you and I
Okay.
and a few friends start a bakery together, and we incorporate it
Okay.
to protect our personal assets.
Okay.
Now, if the bakery can't pay its suppliers, those suppliers can only go after the bakery's assets,
Ah.
not our personal houses or cars or whatever.
Yeah.
That's because the bakery as a corporation has its own, separate patrimony, its own set of assets and liabilities.
Okay.
It's like this legal armor that the corporation wears.
So it's like the corporation is its own person. It can
That's my way to put it.
get sued, own property.
Yeah.
Separate from the people who created it.
Exactly. That separation is also referred to as entity shielding. And since the company's assets are protected from being pulled out by individual owners, that leads to liquidation protection. And, without this protection,
Right.
any owner could just decide to take their share of the assets at any time.
Which would create chaos and instability.
Which would really hurt the company. And its investors, which in this case
Would be us.
includes us.
Yeah, that makes a lot of sense. So legal personality protects the company. What about the investors? That's where limited liability comes in, right?
Exactly. Limited liability is a big one,
It is.
especially if things go south.
It is, yeah. That's when you really need it, right?
Limited liability is like a safety net for investors. No matter what happens to the company, you can only lose up to the amount that you invested. You're not personally on the hook for the company's debts.
All right.
They can't come knocking on your door if the company goes bankrupt.
Okay, so I see why investors would love this.
It's a big attraction.
Yeah, it's peace of mind. But doesn't this shift the risk to creditors then?
Yeah, it does to a certain extent. That's why it's a double-edged sword.
I can see that.
It encourages investment,
Right.
by reducing the risk for individuals. But it also means that creditors are bearing more of that burden. Some even argue that limited liability
Right.
played a role in the 2008 financial crisis, where some companies took on excessive risks, knowing that their investors were protected.
Okay, interesting. So it's a system that needs careful balancing to make sure that it works for everybody, not just investors.
Exactly. Now let's talk about the shares themselves.
Okay.
Those are more than just pieces of paper, right?
Yeah, I mean, I know they represent ownership, but I'm guessing it's more nuanced than that.
It is, you're right. One of the key features of corporate shares is their transferability. But there's a catch.
Okay.
Transferability doesn't always mean free tradability.
Okay, what does that mean?
Well, think about a privately held company, maybe like a family-owned business or something.
Right.
There might be restrictions on who can buy or sell the shares. This helps them maintain control
Okay.
and, keep the company within a certain group of people.
Right.
On the other hand, publicly held corporations, those that are listed on stock exchanges, they typically have shares that are much more freely traded.
Makes sense. So the ease with which you can buy or sell shares really depends on the type of corporation.
It does.
And I imagine that impacts how the company operates and raises capital.
Absolutely. It's all interconnected. Imagine a company
Okay.
with thousands of shareholders,
Okay.
all with their own opinions. How do you manage all those voices and make decisions effectively for the company?
Yeah.
That's where delegated management comes in, and that board structure we always hear about.
Right. It makes sense. You can't have 1,000 people all making day-to-day decisions for a large company.
Exactly.
But doesn't that then create a new set of problems?
Yeah.
If you're not directly running the company, How do you know the people you've delegated to are actually acting in your best interest?
That's the million-dollar question. It brings us to one of the classic dilemmas in corporate law,
Oh, okay.
the principal-agent problem. You remember that car dealer example from the source material?
Vaguely. I remember there was a car dealer.
He benefits from taking his time, even though it's not in the best interest of the person he's representing.
Oh, yeah. I remember that now.
Exactly. So the board of directors, acting as the agent, may not always act in the best interests of the shareholders,
Who are the principals?
the principals.
Right.
There's that potential for misaligned incentives,
Yeah, even with a carefully selected board.
even with a great board.
So even with a board, it's not a foolproof system. It's about managing that tension between
It is.
those who own the company and those who run it.
It's a balancing act.
Right. And it's interesting. We say, oh, the shareholders own the company,
Right.
but their relationship to the company is actually quite complex.
It is.
A share isn't just
The
piece of
Well,
ownership.
It's a bundle of rights.
Right. It's not just about owning a piece of the pie.
Exactly.
It's about how much you get to say and how that pie is baked and sliced.
Perfectly put. So you have things like control rights. You get to vote on decisions.
Yeah.
Capital rights.
Right.
To receive dividends. Those vary depending on the type of share and the company structure.
So there's all these different levels
Below.
of ownership and influence,
Yeah.
even within the same company.
Exactly.
It gets even more interesting
It does.
when you look at the different theoretical perspectives on investor ownership.
So you've got the doctrinal theory, popular in Germany. They see voting rights as inseparable from the share. Direct ownership, direct control.
Okay.
And then you have the political or democracy theory, arguing for shareholder democracy, where each vote holds equal weight, no matter how many shares you have.
That sounds very egalitarian. But wouldn't that be challenging in a company with, a gazillion shareholders?
Exactly. That's where the economic theory comes in.
Okay.
This theory sees shareholders as the ultimate decision makers because they bear the risk of the company's performance.
Right.
It's all about aligning incentives and making sure those with the most to lose have the most say.
Okay, so it's a constant debate about who really calls the shots in a corporation and how to balance those different interests.
It's a balancing act.
Yeah, this is already giving me a lot to think about.
We're just scratching the surface. Now, so far, we've been focusing on corporations.
Right.
But what about partnerships?
Okay, partnerships. Yeah, I know they're often seen as a simpler alternative, especially for smaller businesses.
They are.
But the source material mentions unlimited liability, which makes it sound a little bit scary compared to that corporate shield that we talked about.
It's a key difference. In a general partnership, each partner is personally liable for all the debts and obligations of the partnership. If the partnership goes bankrupt, creditors can go after your personal assets.
Okay.
There's no separation between you and the partnership.
Okay.
But here's where it gets interesting.
Okay.
Partnerships are not always lacking legal personality.
Really?
Yeah, it's not so black and white. So in some civil law jurisdictions, partnerships are actually recognized as entities with legal personality, similar to corporations. This allows them to own property, enter into contracts, sue or be sued in their own name.
So even though they don't have that same level of limited liability, they can still have some of the same legal benefits as a corporation.
Exactly.
Interesting.
And even in common law jurisdictions like the U.S., things are evolving. We're seeing a trend towards recognizing partnerships as legal entities in certain situations.
Okay. So what's driving that change?
Well, think about it from a practical perspective.
Okay.
Recognizing partnerships as legal entities simplifies a lot of things.
Okay.
Makes it easier for them to own property, enter contracts, and interact with the legal system. Plus, it can clarify how any internal disputes between partners are handled.
Right. Makes sense. So partnerships aren't as simple as they seem.
They're not.
At first glance, we have a whole range of partnership types
They do.
to explore. General, limited liability, and even limited liability, limited partnerships.
It can get a bit confusing, so let's break it down. Starting with general partnerships, which we already talked about. Those involve shared management and unlimited liability.
Right.
All partners are in the same boat.
Okay.
Steering together, sharing the risks and rewards.
Okay.
Now, what about limited partnerships?
Oh, yeah. Limited partnerships I know involve both general and limited partners, but what's the distinction there?
Yeah, so in a limited partnership, you have at least one general partner who manages the partnership, and faces unlimited liability.
Okay.
But you also have limited partners
Sure.
who invest in the partnership but have limited liability.
Meaning their personal assets
Meaning their personal assets
are protected.
are protected, limited to the amount that they invested.
So the limited partners are more like passive investors.
Mhm.
They have the potential upside,
Exactly. They're enjoying the ride but not steering the boat.
but not steering.
Okay.
Now, limited liability partnerships,
Okay.
or LLPs, take this concept a step further.
Right. In an LLP, all partners have limited liability,
Great.
even for the actions of their fellow partners.
So everyone has their own little life raft,
That's a great analogy.
even if the boat sinks.
Okay. Now, there's one more
Good.
that's a little less common, but still worth mentioning.
Okay.
It's called a limited liability limited partnership,
Oh, an LLOP.
LLLP.
That's a mouthful.
It is. It's basically a hybrid
Right.
of a limited partnership and an LLP. It offers the same structure as a limited partnership with general and limited partners, but it extends limited liability to the general partner as well.
Oh, so even the captain of the ship gets a life raft.
Exactly. This type of partnership provides maximum liability protection for all partners.
Okay.
Makes it attractive in certain situations.
Okay, so we have a whole spectrum of partnership structures. Choosing the right one is crucial,
It is.
especially when it comes to understanding how much personal liability you're taking on. Now I'm wondering, is there a way to kind of combine the best of both worlds? The limited liability of a corporation, but the flexibility of a partnership,
That's where the uncorporation comes in.
the uncorporation. It sounds like a mythical creature,
It does.
but I'm guessing it's a real thing
It is a real thing.
in the legal world.
It's becoming increasingly popular.
Okay.
Uncorporations or hybrid business forms offer the benefits of limited liability
Okay.
while retaining some of the flexibility and tax advantages of partnerships.
So can you give me an example?
Absolutely. The most common one in the U.S. is the LLC, Limited Liability Company.
Right, LLC. Okay.
These are great for smaller businesses, joint ventures, family firms.
Okay.
They offer that same limited liability protection as corporations, but they're taxed differently.
How so?
Profits and losses pass through the LLC and are reported on the owner's individual tax returns. This avoids that double taxation
Okay.
that you can see with corporations.
So that's a big advantage.
It is.
So uncorporations are blurring the lines then. They are. Between traditional corporations and partnerships.
They are, reflecting that changing regulatory landscape.
Right. Businesses are evolving. So the legal structures have to evolve
Exactly.
to support them. Now, no matter what the structure, though, one thing remains constant. The need for capital.
Money?
Yeah, the source material lays out the two main ways companies raise money.
Okay.
Debt financing, essentially borrowing money, and then equity financing, issuing shares.
Debt and equity, the two pillars of corporate finance,
Yeah.
they have their own characteristics, advantages and disadvantages.
Okay, so
Yeah,
I'm already sensing some of those. Hidden logic connections.
we'll get to them.
You mentioned earlier. Can you break down the key differences between the two?
Absolutely. So let's start with debt.
Okay.
Debt financing involves borrowing money from lenders, like banks or bondholders.
Right.
These loans come with fixed claims,
Fixed claims, meaning?
meaning that the lenders are entitled to repayment
Okay.
of the principal plus interest, no matter how the company performs. It's like a guaranteed return.
Debt is more about stability
Yeah,
for the lender,
it is.
while equity is more about
Dave?
the potential for growth and higher returns.
But with more risk, yeah.
Yeah, higher risk, higher reward.
Okay.
Now, equity financing
Okay.
involves issuing shares of stock
Okay.
to investors,
Yeah.
basically selling them ownership stakes in the company.
Okay.
Now, these shares represent residual claims.
Residual claims.
Yes, meaning shareholders are entitled to whatever's left over after all the other obligations,
Including debt.
including debt,
Okay.
are paid.
Right.
So if the company makes a big profit,
Shareholders.
shareholders get a bigger return.
Okay.
But if the company loses money, shareholders might not get anything.
Right. Their return is based on whatever's left.
Residual.
Okay, residual. So debt is like, a loan with fixed interest rate. Equity is like, you're buying a piece of the action.
Exactly.
Okay.
With the potential for
Right.
big gains and big losses.
Now, since equity holders face more risk because of that residual claim,
There are rules to protect creditors
yes,
who have those fixed claims.
they do.
These rules are called capital protection rules.
Capital protection rules, they can be complex.
Yeah. The source material actually contrasts the approaches to capital protection in Europe and the U.S., suggesting that Europe has more comprehensive and stricter regulations in this area.
They do.
Can you give me a real-world example of how these differences might play out?
Absolutely. Imagine you're a European company
Okay.
looking to acquire
Yeah.
a U.S. company.
Okay.
You might be surprised to discover that the U.S. has less stringent rules around how companies can use their capital, particularly when it comes to distributions to shareholders.
Okay.
For example, the U.S. might allow a company to pay dividends even if it has a lot of debt. Europe might have stricter rules that limit those payments if the company's financial health is weaker.
Okay, so those regulations could create challenges
Yes.
in structuring the acquisition
Yeah.
and making sure that everybody
Yeah.
is protected.
Yeah.
Okay. That's a great example of how seemingly technical legal differences can have a big impact
They do.
on business decisions.
They can.
All right, so once a company has raised that capital, either through debt or equity, it needs to decide how to manage it effectively.
It does.
That brings us back to dividends and share repurchases.
Those are two key strategies
Right.
for distributing profits to
Okay.
shareholders.
Right, we talked about those earlier.
Yeah.
I think we're ready to dive a little deeper.
Let's do it.
It seems like these decisions can have a big impact on both the company's financial health and its relationship with its shareholders.
Absolutely. Dividends and share repurchases represent two different philosophies
Okay,
about how to create shareholder value.
so can you unpack those philosophies for me?
Of course, dividend payments are direct cash distributions to shareholders, usually paid out on a regular basis, like quarterly or annually. It's a way for companies to share profits with their owners,
Okay.
reward them for their investment, signal their confidence in the future.
So dividends are like a steady income stream
Yeah, you could say that.
for shareholders. Okay, and then share repurchases.
Share repurchases, also known as buybacks.
Buybacks, right, okay. I know those.
They involve the company using its own cash to buy back its shares from the market.
So what's the logic behind that?
Well, when a company repurchases its shares, it reduces the number of outstanding shares.
Well, okay.
This can increase the value of the remaining shares,
Okay.
as each share represents a larger ownership stake.
So the company's investing in itself.
Exactly. Buybacks signal that the company believes its shares are undervalued, and they can boost earnings per share.
Okay.
Which is a key metric for investors.
I remember the source material mentioned that Apple was historically reluctant to pay dividends.
Oh, yeah. They preferred to just hold on to their profits, reinvest them. Why would a company choose to do that instead of distributing them to shareholders
Right.
through dividends or buybacks?
That's a great example.
There's a few reasons. Companies might reinvest to fuel growth, pursue acquisitions,
Right.
or just maintain a cash reserve
Yeah.
for future opportunities or, unexpected challenges.
What's about balancing those priorities?
It is. You've got creditors
Right.
who've loaned money to the company.
Right.
They prefer value retention,
Okay.
meaning the company keeps those profits,
Yeah.
uses them to strengthen its financial position. Shareholders, on the other hand, often prefer value maximization,
Okay.
meaning the company distributes profits through dividends or buybacks, boosts the value of their shares.
Well, that's another example of those competing interests
Oh, another one.
we've been talking about. You have the desires of creditors for stability versus the desires of shareholders for returns.
Exactly.
And the board of directors has to kind of, walk that tightrope.
They do. They have to balance those competing demands
Yeah.
and make decisions that are in the best long-term interests of the company.
And of course, all its stakeholders.
Exactly. And it all highlights the importance of corporate governance.
Oh, yeah. Corporate governance you mentioned earlier, but
Yeah.
can you remind me what that's all about?
Yeah. So corporate governance is that set of rules and practices and processes that ensures that the companies run effectively and ethically,
Okay.
aligning those interests
Yeah.
of managers with shareholders.
Yeah.
Minimizing the potential for conflicts of interest.
So it's like the rule book
Yeah.
for the game,
Yeah.
making sure everybody's playing fair.
Exactly. Corporate governance frameworks can take many forms. Codes of conduct, legal regulations.
As we've seen, Europe and the U.S. have very different approaches.
Yeah, Europe favors that more principles-based approach. U.S. is more rules-based.
Right, okay, but ultimately, the goal is the same,
The goal is the same.
to create a system that promotes transparency.
Accountability and fairness.
Right, so it's about creating a system
Yep.
that fosters trust
It is.
and ensures everyone's playing by the rule.
Exactly. Now, a key element of any corporate governance system is the board of directors.
The board of directors, okay.
They're the guardians of the company, tasked with overseeing management, setting that strategic direction, making sure the company's operating in the best interests of its shareholders.
So we've talked about their role in general. Can you break down their responsibilities a little more?
Yeah, so those responsibilities are wide-ranging and very important. They include setting that strategic direction, working with management, develop the company's long-term vision and goals. They also oversee financial performance. They review the company's financial statements, make sure that, the company is financially sound and sustainable. They also approve major decisions. So things like mergers, acquisitions, divestitures, investments. They're acting as a check on management, ensuring those decisions are in the best interest of the company and its shareholders.
Right. And of course, they monitor
management performance, right?
Yes. They evaluate the performance of the CEO, senior executives, set those performance goals, provide feedback, make sure that management is actually accountable
for achieving results.
Makes sense.
And of course, they need to ensure compliance, oversee the company's compliance with all those applicable laws and regulations to protect the company's reputation, ensure its long-term viability.
That's a lot of responsibility.
It is a lot.
Yeah.
It's important to have a well-structured, effective board with the right people.
With the right people.
Yeah.
They've already talked about one-tier versus two-tier systems.
Yeah.
I'm curious about board composition.
Board composition is crucial.
Yeah.
The right mix of directors can really enhance its effectiveness.
So can you give me an example of what that diversity might look like?
Yeah. So a well-composed board might have directors with expertise in finance and accounting to oversee, financial performance, legal and regulatory affairs, operations, technology, marketing and sales, human resources, diversity. You really need a team of directors who collectively have that knowledge and skills to guide the company through this complex business world.
And especially as businesses becoming increasingly globalized, I imagine it's important to have board members with international experience and different cultural sensitivity.
Cultural sensitivity, for sure.
Now, we've talked about independent directors. I'm still a little fuzzy on why they're so important.
They are important. They provide that objective oversight of management, ensure that those decisions are made in the best interest of all shareholders.
So they're like the neutral referees.
That's a great analogy.
Of the corporate game.
They ensure fairness and balance, ask those tough questions, hold management accountable.
Now, the source material highlights this trend toward convergence in board structures, with more companies adopting things like delegating powers to management and increasing those independent directors.
Yeah, that trend.
What's driving that convergence?
That trend reflects that growing global consensus on the importance of good corporate governance, recognition that certain practices, like having independent directors, can enhance board effectiveness, protect shareholder interests.
Right, so it's a combination of those best practices, investor pressure.
And investor pressure, for sure.
Right.
They're demanding greater transparency and accountability.
From the companies
they invest in. Exactly.
And as corporate governance continues to evolve, we can expect to see further convergence around those key principles and practices.
Exactly.
Now, one aspect of board structure that's particularly intriguing to me is labor representation on boards.
Representation.
You mentioned that earlier. In the context of some European countries like Germany.
It's a unique feature of corporate governance in certain European countries. It gives employees a voice at the highest level of decision-making, ensures their interests are considered.
So that's very different from what we see in the U.S., where it's primarily executives and independent directors.
Right. It reflects a different philosophy about the role of corporations in society.
Right.
It views corporations as social entities with responsibilities, not only to shareholders, but also to their employees.
So it's about balancing the interest of capital and labor.
Exactly.
Okay.
And while co-determination isn't common in the U.S., there is growing interest in exploring alternative models of corporate governance that give employees a greater voice.
It's fascinating to see these different approaches.
It is.
Reflecting those different social and economic contexts.
Absolutely.
I
Now,
get that.
shifting gears slightly, let's talk about those responsibilities of directors themselves,
Okay.
the duties of care, and
Right.
loyalty.
Right.
Those are cornerstones of ethical and effective corporate governance.
So, break those down for me.
Absolutely. The duty of care requires directors to act with diligence and competence, do their homework, gather the information, make informed decisions.
So it's about avoiding that. Negligence, not just rubber stamping whatever management says.
Exactly. Duty of loyalty is about putting the company's interest ahead of their own, avoiding those conflicts of interest, acting with integrity, making decisions that benefit the company.
So putting the company first.
Putting the company first.
Okay.
Now, these duties are often enshrined in law.
Right.
They can have serious consequences if they're breached.
Right. The source material, actually, provides examples of legal frameworks
Correct.
for director duties.
Yeah.
In different jurisdictions, I imagine there's quite a bit
There is.
in how those are defined and enforced.
Different countries have different approaches, but those underlying principles of care and loyalty are pretty consistent.
Okay.
So can you give me some examples? Yeah, Germany, they have a strong emphasis
Okay.
on the duty of loyalty, focused solely on the good of the company.
Yep.
The UK Companies Act
Mm.
of 2006
Okay.
codifies director duties. And then in the US, you have the Delaware General Corporation Law, sets those standards of fairness and disinterestedness.
So it's reassuring to see that there's that global consensus
They're in.
on ethical conduct for those in power.
Exactly.
Yeah.
And these frameworks are complemented by corporate governance, codes, and best practices
Right.
that provide guidance.
Makes sense.
Now, it's
Fair.
important to remember that directors aren't the only ones with a stake in the company.
Right. Shareholders.
Shareholders, exactly.
The ultimate owners.
They're the lifeblood of any
Oh.
corporation. So,
We've already discussed shareholder rights
right,
in general.
right.
I'm particularly interested in the annual general meeting
AGM.
or the AGM. That's a cornerstone
Okay.
of corporate democracy.
Yeah.
Formal gathering of shareholders. Usually once a year, they have the opportunity
Yeah.
to hear from the company's leadership, ask questions, vote on those important matters.
Okay, so the source material highlights the different types. Shareholder rights, decision-making, information, procedural rights.
Yeah, so decision-making rights allow them to vote on the
Okay.
election of directors, approve
Wow.
major transactions.
Amendments to the Articles of Association.
So shareholders really have a direct say
They do.
in how the company's run.
It's not a passive investment. They have an active role to play.
That's a key principle of corporate governance.
Mm.
Giving those shareholders a voice.
It is?
What about information rights?
Yeah, information rights give shareholders the right
Okay.
to access key information
Okay.
about performance, financials, governance practices.
What kind of information are they entitled to?
Well, they get those annual reports, comprehensive
gotcha.
reports about financial performance, operations, plans.
Okay.
They also get financial statements
Okay.
and proxy statements.
So it's about keeping them informed
Keeping them informed, empowering them to make decisions.
about their investments.
Exactly. Transparency is essential
Right.
for building trust and accountability.
What about those? Procedural rights.
Yeah, procedural rights ensure
Okay.
a fair and transparent process
Oh,
for shareholders to exercise their rights.
So those include,
Things like the right to call special meetings, submit shareholder proposals, nominate directors for election.
so it's all about making sure that the system's fair,
Yeah.
accessible, they can be heard.
Exactly.
And those rights are enshrined
They are.
in law, enforced by
Wow.
regulators.
Exactly. The source material actually mentions the European Shareholder Rights Directive.
Yeah, the shareholder rights
A
for it.
landmark piece of legislation. Enhance shareholder engagement. Make it easier to exercise their rights.
Right, especially in cross-border situations.
Cross-border.
You know, it's a major step then,
It is.
empowering shareholders, promoting that active participation.
Absolutely.
Now,
Yeah.
despite all these mechanisms, to protect these rights, there are still practical challenges,
There are.
the biggest hurdles.
The biggest challenge
Yeah.
is the free rider problem.
The free rider problem.
Yeah.
Small shareholders feel like their vote doesn't really matter.
They figure, why bother?
Yeah,
My vote won't make a difference.
right.
And they're right, to some extent. In a company with millions of shareholders, your vote isn't going to swing the outcome.
But collectively,
Yeah.
if everyone took that approach,
Yeah.
it would undermine the whole system.
Exactly.
Yeah, it's a classic collective action problem.
Right, where Everyone's better off if everyone participates.
Yeah.
But no one feels like their participation matters.
And it's made worse by the fact that shareholders are busy
Yeah.
reading those proxy statements and financials. Daunting for the average person.
Right.
So those rights might be there,
Yeah.
but actually exercising them can be a hurdle.
Yeah, no. I want to talk about minority shareholders.
Majority shareholders.
Yeah, those who have a smaller percentage compared to the controlling shareholder.
They're often at a disadvantage.
Yeah.
Especially where you have a small group
Right.
holding the majority of the power.
Yeah, so they may find it hard to,
It might.
influence decisions get heard.
Yeah, they
Right.
might. The source material mentions tunneling.
Tunneling, where those assets are siphoned. Tunneling is a classic example of how minority shareholders
Right.
can be exploited.
And there are other tactics.
Other tactics, like related party transactions,
Yeah.
where controlling shareholders make deals with companies they have a personal interest in.
So that's about preventing them in power from enriching themselves.
It's about fairness,
Right.
protecting everyone, no matter how big their stake is.
So how can minority shareholders protect themselves?
Well, there's several tools and strategies.
Okay.
So cumulative voting can help.
Cumulative voting, I'm down.
That allows them to concentrate their votes
Yeah.
on those specific director elections,
Right.
independent directors.
Okay.
They can provide that objective oversight. And some companies grant minority shareholders special voting rights
Okay.
on certain matters,
Okay.
like mergers, acquisitions, those major asset sales.
So that gives them more leverage.
It does.
And in some cases, minority shareholders can band together and file a class action lawsuit.
Exactly. So it's multi-layered. It involves voting mechanisms, board composition, special rights, legal recourse.
Now, as companies become more globalized, with those ownership structures spanning multiple jurisdictions,
It gets even more complicated.
Right.
It's not just about one country anymore. You have to understand the
Yeah.
interplay between all these
right.
different legal systems.
So it's a challenging but important aspect.
It is.
Thorpe law.
And as those global markets continue to integrate, the need for that minority shareholder protection is only going to grow.
Yeah. Let's shift gears to sustainability.
Okay, sustainability, it's no longer just a nice to have, it's a business imperative.
Investors, consumers, employees, regulators are demanding companies be responsible
For their impacts.
on the environment and society.
Yeah.
The source material traces that evolution of corporate social responsibility.
CSR from philanthropy,
Okay.
integrating it into core business.
So we've come a long way from
Yeah.
just
Yeah.
writing checks to charity.
Yeah.
It's actively transforming how companies operate.
This evolution is being driven by several factors.
What are those factors?
Growing public awareness.
Mm.
People are concerned about climate change,
Right.
social justice, ethical business practices. They want companies to align with these values.
Makes sense.
You also have investor pressure.
Oh,
So
no.
those institutional investors, they're incorporating ESG factors
Right.
into their investment decisions. Governments around the world are enacting laws to promote sustainability.
Okay.
And companies are realizing sustainability can give them a competitive advantage.
Okay.
So social pressure, investor demands, regulations,
Right.
and business opportunities.
They're driving this
Yeah,
shift
exactly.
towards sustainability, and how is that reshaping the legal framework?
Well, sustainability is impacting corporate law in several ways.
How so?
You've got disclosure requirements.
Disclosure.
Companies have to disclose their impact.
Right.
You also have fiduciary duty.
Right.
It's being challenged by the concept of stakeholder capitalism
Right.
and M&A due diligence. Sustainability is a key factor now,
Yeah.
and companies are articulating a clear social purpose.
Okay. So
Right.
it's woven into
Right?
corporate law
It's woven in.
and governance. It's not
But
just an add-on.
It's not a side project.
Okay.
So as sustainability continues to gain momentum, we're going to see profound changes
Okay.
in corporate law.
Now, one of the key aspects of sustainability is transparency.
Transparency.
Right.
Yeah.
Companies
Yeah.
are being asked to disclose more information about their practices. The source material highlights two main approaches,
Okay.
voluntary and
Right.
mandatory. Can you explain the difference?
Yeah, so voluntary transparency involves companies choosing to go above and beyond
Okay.
what's legally required.
So it's about being proactive, showing leadership.
Demonstrating leadership, exactly.
And there are different frameworks, right?
Frameworks and initiatives.
That they can use. Global Reporting Initiative, Sustainability Accounting Standards Board,
The Task Force on Climate-Related Financial Disclosures.
All those acronyms.
Does.
Those acronyms.
It's not just about saying, we're green.
Right. It's about backing it up with data.
Right.
And there's that consensus
Yeah.
that standardized reporting is important.
Yeah, what about mandatory reporting?
Yeah, mandatory reporting involves
Okay.
government stepping in to require companies
Right.
to disclose certain information.
Right.
This could be specific. Regulations on environmental emissions or broader mandates.
Okay.
The source material highlights the EU directive on non-financial and diversity information.
Yeah, it seems like Europe is leading the way.
It is a landmark piece of legislation.
Yeah.
That's a high bar
Right.
for corporate transparency. So companies have to report on a wide range of topics.
Okay, what are those topics?
So environmental matters, their impact on the environment,
Okay.
emissions, water usage, waste management, biodiversity,
Okay.
social and employee matters. So how they treat their employees.
Their policies on diversity, human rights, anti-corruption.
So it's pretty comprehensive.
A comprehensive approach.
Yeah. It's giving stakeholders that holistic view.
The EU directive is based on the principle that transparency is essential
Right.
for accountability. Stakeholders have a right to know
Okay.
what are those impacts.
So what's the rationale behind this push?
Right.
Why is it seen as so important?
Several reasons. Levels the playing field.
Okay.
Make sure all companies are subject to the same requirements.
Right.
Stakeholders can compare performance.
Okay.
This can drive improvements across industries.
And of course, it empowers stakeholders.
Empowers those stakeholders. Make informed decisions.
Investments.
Products and services. And of course they can. Hold companies accountable.
Right. It's about putting that information in their hands.
And ultimately, mandatory reporting.
Yeah.
Aims to incentivize companies
Like,
to improve.
do better.
To do better.
It's like that old adage, sunlight is the best disinfectant.
It is.
So that transparency can drive change
It can?
and its sustainability.
Yeah.
Because increasingly integrated, we can expect to see more jurisdictions adopting those mandatory reporting requirements.
Exactly.
Now, let's shift gears a bit to mergers and acquisitions.
M&A.
Or M&A, world of high-stakes deals.
It is.
Right?
Corporate maneuvering.
Sometimes hostile takeovers, high stakes.
The source material differentiates between mergers, where two or more companies combine, and acquisitions, where one company takes control. Can you explain the key differences and why they matter?
Absolutely. A merger is like a marriage
Oh,
where
yeah.
two companies decide to join forces, create a new combined entity.
Right.
Both companies cease to exist. Their assets and liabilities
Yeah.
are merged. Acquisitions. More like a takeover.
Okay.
One company, the acquirer, purchases a controlling interest.
Mergers, more collaborative while acquisitions. One company asserting control.
It is a good way to think about it. And those differences have important legal implications.
Exactly.
Shareholder rights, regulatory approvals, tax considerations. So
Yeah.
give me an example of how that works.
Yeah, in a merger, shareholders from both companies
Okay.
typically need to approve
Because it's a new entity.
new entity.
Yeah.
You might also need regulatory approvals
Okay.
if it creates a dominant position or antitrust concerns.
So mergers involve a lot of
They do.
legal and regulatory hoops to jump through.
Now, acquisitions can be structured in different ways, but they generally involve the acquirer buying that controlling interest by buying shares directly from shareholders
Right.
or making a tender offer,
Tender offers. We talked about those earlier.
public offer, made to all shareholders
Right.
to buy their share
It's like Kareemia.
at a premium.
Right.
So acquisitions also need regulatory approvals,
Okay.
especially antitrust or sensitive industries,
Mhm.
banking, telecommunications,
Okay.
tax considerations also play a
Cool.
role.
So both mergers and acquisitions,
Are complex
they're complex.
with significant implications.
They do.
And the legal framework can vary significantly. It does.
Across jurisdictions. The source material goes into the European Takeover Directive, highlighting its provisions.
It sets a high standard
Okay.
aimed at ensuring transparency,
Mm-hmm.
fairness, shareholder protection,
So Europe has a comprehensive,
a comprehensive regulatory framework.
okay, can you highlight some of those key provisions?
Absolutely, you have. The mandatory bid rule
Okay.
requires any shareholder Acquiring a certain percentage
Okay.
to make a public offer to buy the rest
Yeah.
at a fair price.
Prevents this
Or-
creeping takeoff.
Exactly. You also have the equitable price requirement.
Okay.
Make sure that. The offer price reflects the highest price paid.
You can't take advantage.
Exactly.
Any weird fluctuations.
Right.
Board neutrality rule
Okay.
prevents the target company's board
Okay.
from taking action to frustrate the bid
Okay.
without shareholder approval.
So the board has to act in everybody's best interest.
All shareholders,
Right, not just their own.
not just their own.
And then you have the squeeze out and sell out rules. So that provides mechanisms for majority shareholders to buy out minority shareholders or
Right.
vice versa.
Right.
Prevents those minority shareholders from being trapped in an
Right.
undesirable situation.
Right, so the European Takeover Directive, it's about ensuring fairness and transparency.
Fairness, transparency,
That-
and shareholder protection.
Well, the European Takeover Directive sets that framework.
Mhm.
Individual countries, they have their own
Great.
regulations.
They do.
Right. The source material dives into the UK's City Code on takeovers and mergers, highlighting its emphasis on the principle of equal treatment.
Yeah, the UK system
Yeah.
is known for its emphasis on fairness,
Okay.
transparency,
Yeah.
accountability.
And the City Code.
Well, City Code
Yep.
is a set of principles and rules.
Right. So not technically law.
Not a
Oh,
law.
it-
Governs.
It governs those takeover activities.
It's enforced.
It's enforced by the takeover panel.
Okay.
Independent body.
Okay.
Ensures compliance. Makes sense.
Yeah.
So the City Code is based on
Yeah.
that principle.
And
That-
all shareholders should be treated equally.
Okay. Takeover process should be conducted with integrity.
Exactly. Prohibits those selective disclosures, misleading statements, actions that would artificially inflate or
Right.
depress the share price.
So it's a system designed to protect everybody.
It is.
Now, the U.S., how does their approach compare?
The U.S. is more flexible,
Okay.
less prescriptive, relies more on disclosure and market forces.
So more market-driven?
Market-driven, exactly.
Belief.
Competition among bidders, informed shareholders
Right.
will ensure fair outcomes.
So less interventionist,
It is.
but still relies on disclosure
Disclosure, yeah.
for transparency
Yeah.
and shareholder protection.
And speaking of shareholder protection, the source material ends with a discussion of shareholder appraisal rights.
Shareholder appraisal rights. Okay.
Those are that crucial protection mechanism that allow dissenting shareholders
To be bought out.
to be bought out
At a fair price.
at a fair price. Right.
If they disagree.
It's a way for them to say, I don't think this deal's in my best interest.
I want out.
I'm out.
It is a valuable safeguard,
Yeah.
especially
Yeah.
when they feel like their voices aren't being heard.
Right. So
It gives them that option.
gives them that option to exit at a fair value.
So another layer of protection,
Yes.
this complex world of...
It's a reminder that corporate law is ultimately about balance,
Right.
fairness, transparency, and accountability.
This deep dive have been incredible. We've covered so much.
We've covered so much ground.
Yeah, corporate law is dynamic and ever evolving
It's constantly adapting.
to those changing realities.
Of the business environment.
One of the key takeaways is the
Yeah.
importance of balance.
Balance between all those interests. Stability and growth,
Yeah,
short-term profits,
Yeah.
long-term sustainability.
exactly.
As we've seen, there's no one-size-fits-all approach.
No one size fits all.
What are some of the
It's blown
biggest
up.
trends and challenges that you see on the horizon? Well, sustainability
Okay.
will continue to be a major driver.
Okay.
Technology creates legal challenges and opportunity.
Globalization,
Globalization, we have to navigate all those complexities. And stakeholder capitalism,
stakeholder capitalism, yeah.
challenging that traditional view.
So it's a dynamic time
It is.
to be involved in corporate law. Lots of challenges and opportunities.
Thank you for sharing your insights with us today.
I feel like I have a much deeper understanding now.
I hope you found it as insightful as I have.
I certainly have.
Yeah.
And I'm sure our listeners appreciate all that information. Thank you for hosting this stimulating conversation.
The pleasure was all mine.
And to our listeners, thanks for joining us on this deep dive into the world of corporate law. We hope you found it informative and engaging,
And be sure to tune in to future episodes.
where we'll explore more fascinating topics.
Until next time.